Today, folks, unlike a lot of YouTubers out there that have been playing around in small caps, day trading, or crypto, I'm going to give you full clerical insight into the performance under my $360,000 dividend stock portfolio that is now trading down 8%, or roughly $30,000 from the all-time high. Luckily, still outperforming the S&P 500 to the downside, but I've done a lot of recent adjustments that I've continued to do over this year as I continue to adjust my risk tolerance that I think will offer a lot of good insight to you guys. So if that's a conversation you can appreciate, hit that like button, because I want to talk about some data first that I find very intriguing. Recently, I did an interview with a multi-millionaire investor, and we talked about how important it is to not get off this ship when the waters get rocky. And I found some data from JP Morgan where they offer some investment advice that really kind of solaces your soul, gives you some solitude to just kind of take a breath and understand what you're doing over the long term, because they're showing you the return of a $10,000 investment over the last 20 years in the S&P 500 and what would have happened if you jumped ship and missed some of the best days in the market. So if you were in the market fully for the last 20 years, your $10,000 would be worth $61,685. If you missed the 10 best days over the last 20 years, it would greatly reduce that by half. You would have only made $28,000. Now, if you missed 20 of the best days, you'd only have $16,000. And then if you missed the 30 best days, you'd be null basically. And then if you missed the 40, 50, and 60 best days, you'd be negative over the last 20 years. That is literally only missing 1 to 2 months out of the entire 20 years of being in this market here, folks. And just kind of taking a deeper look, because the NASDAQ as of today, guys, is now trading down 25.5%. The S&P 500 is down 15.81%, and the TSX S&P, so the 60 largest companies in Canada, very similar to the S&P 500, is now down 4.73%. But even if you're trying to not look at the basic indexes, guys, you cannot really hide out in gold. Gold is continuing to trend with the market to the downside here, now at $1,861. Bitcoin is following the same suit. It looks like Bitcoin's going to be going down into the $20,000 range, and it's just wild to think that you don't, whatever strategy you think is the best in this market, the only strategy really working is oil and energy stocks, with a few exceptions out there, of course. We're going to talk about some of those exceptions because they do sit within my portfolio. But before we look at my individual holdings, I really want to share with you the performance, because most YouTubers out there do not talk about the performance of their portfolio. They might tell you they're down, they're this, they're that, but very few people are going to show you what I'm about to show you, which is each individual account and how I've been doing over this last little bit of time here, guys, because I am very, very fortunate to still be drastically outperforming most of the basic indices, well, all of the basic indices in every single one of my accounts except for one. Now, taking a look, this is my tax-free savings account. It makes up just under 50% of my total investments, probably about 40%. And as of the making of this account in June of 2017 till April of 2022, guys, it's still up 157% against the S&P TSX. It's only up 38%. The S&P 500, that's only up 71%, and the NASDAQ, that is up 98%. So we're outperforming the NASDAQ here by about 59% still, which is very fortunate, because it only takes a few positions in a market like this to completely wipe out your gains. Now, taking a look at my managed account, my longest standing account, which is just a general regular brokerage account, which started back in September of 2014. This account is up 357% against the S&P TSX. It's up 39%. The S&P 500 up 106%, and again the NASDAQ, that's up 169%. So we are drastically outperforming all of these basic composites over this time period, which is just unbelievable, right? And then arguably one of my best performing accounts, my registered retirement savings plan, that is up 262% against the S&P TSX. It's up 28% in the same time frame, and this goes back to August of 2019, by the way. So this account has really only been around for just under a few years. The S&P 500 in the same time frame is up 38%, and the NASDAQ is up 50%. This account, I did a lot of shifting around from owning things like Tesla to getting into Johnson & Johnson, and now I'm primarily just holding indexes in this account. So the stability of this account, I've been managing it very, very well for it to generally be almost pushing its all-time high going into April here. But let's talk about one of my worst accounts, which is my newest account, my corporate account, which isn't really giving me the adjustments coming into May here, because I'm pretty confident that I am getting pretty close to the performance of the NASDAQ, maybe not to the downside to the same extent, but take a look here, because this blue line represents my basic performance against the indices, and I am underperforming the S&P 500 and the TSX Composite currently, but I don't think I'm nearly to the downside of the NASDAQ because I haven't been purely involved in kind of the NASDAQ based companies. But that's been the performance as it stands in this moment. All these accounts combined, if you were to bring it all together, guys, again, down about 8% overall, basically year to date here. But let's dive down into what I've done, the adjustments I've made as I continue to find my risk tolerance. Now, I have been flip-flopping around in this market, trying to figure out if the market was going to recover, because many of you know that we went through this wicked rally here just early on where we thought we were coming off the lows, but clearly it was a bear market rally into a continued sell-off. And I wasn't sure exactly what direction I was going in here. I was using indexes as Parker places, but I've kind of come to the conclusion at this point, because I don't really know what's going on. I can't really get a sentiment off earnings, and the market is just purely unpredictable in the near term. And I've realized that if I'm just going to keep cost averaging in for the time being, I just need to be doing indexes, guys, because I can get the best of both worlds with companies I love through two indexes. Obviously the S&P 500, which I've mentioned, since it's large weighted the top 10 holdings to over 30% of the entire fund, largely being Apple, Microsoft, all those companies I love. I realized that I could really just buy the S&P and own a lot of the companies that I love there in bigger amounts, and then I can just cost average in month over month, which is my current plan. And then same with VYM, guys. VYM top weights my favorite companies like JP Morgan, Johnson & Johnson. But the difference with these accounts over what I would be doing is managing them in an unemotional way, because basically in a moment like this, guys, we remember how hard things like Mobile were hit, and I'm not a fan of oil stocks. I've never owned pure play oil. I don't plan on owning pure play oil in my accounts. But the difference is if you don't hold those kind of companies, guys, when they start rallying back against the market, those are the things that are holding up some of these indexes, right? And if you have zero exposure to those, you are getting absolutely devastated. But these things do it in a non-emotional way. It's all just purely based off their market cap. And now some of these oil stocks are larger weighted in VYM, offering much more stable performance. So I made about 50% of my portfolio, about 24.6% in VOO and about 25.4% in VYM. And then the other 50% of my portfolio, I was debating on just dumping a lot of this into the, I think it was VCE, don't quote me on that, but an S&P TSX index. But the problem with the S&P TSX index is that the really large weighted the top holdings by about 50%. I always have a hard time buying Canadian indexes because they're so largely weighted in those top holdings. I feel like you're not really going to do too poorly just hand selecting some of those Canadian companies. And I've largely just kept my OG Canadian companies that I've held pretty much since the beginning of my investing career, with a few exceptions here. So I've still got my REITs, my telecom with the recent adage of Bell. I've concentrated a few of these. I added a little more to Enbridge, a little more to Bell. My Canadian financials, I top weighted a little bit more into Royal Bank just to give it an equal weighting here. And because of my Canadian stocks and the TSX has been so much more stable than the US stock market has been, it's really offered some stability against the entire portfolio. And I'm obviously expecting the S&P 500 to continue to trend downwards, but luckily VYM is a little bit more stable, so it offers a bit more stability. And then I'm still getting a lot of growth from the Canadian markets with things like TELUS that posted earnings we discussed, which actually is still trading up this year. I mean, RioCan, the REITs have been doing relatively okay. The banks have been pulling back and are now red on the year, but they're still not anywhere near the performance of the S&P 500 to the downside. And we're going to get some of those bank earnings coming out, and it's going to be really neat to see what happens with financial stocks and those real estate stocks in this interest raising environment and with a slowdown in the current real estate market. But again, guys, I'm not really getting too crazy at this point. I'm still keeping my Bitcoin position, which is obviously trading down, and I'm still just stacking cash pretty aggressively. And this still comes into play with my corporation because I have to pay taxes at the end of this month, and I don't know exactly what I owe, but this account could change drastically depending on how much the government takes from me. If they take less, I end up with a lot more cash, which would upweight the entire portfolio. But as we can see, guys, just taking a look at the dividend income, another reason that I love holding indexes right now is because I can collect passive income in a much more stable manner where I'm not nearly as worried about the impact of all these individual companies and having to fixate on them and kind of just stress myself out. And again, you guys can say I've flip-flopped around. I've done this. I've just been really working on repositioning myself on this ship. And like I said, I ended up with almost 30 something stocks before I realized realized that I'm just getting too out of control trying to over diversify and over manage. So this is going to simplify the management, allow me to take a breath in a period where my life is becoming a little bit more scattered. My parents are moving into retirement. I've been very busy with a lot of personal stuff. And it's like I said, it's just all these things in my personal life have led me to wanting to have a more passive investing style, which a lot of you guys in our chat group obviously have been doing long before I have been. A lot of people have been weighting indexes by 50%. I wanted to shout out a few people, but maybe I'll just leave their names out of it for now because I really appreciate them offering their portfolio insights in our personal chat groups. It's really helped me out a lot and just offering me some opinions because I'm not perfect at this by any metric here, folks. I've just had a lot of luck with a lot of due diligence, and I don't want to lose everything that I've worked so hard for. I want to mention here as well, if you guys want to chat with me directly, get funny memes in the stock market and hear from other people's portfolios, just get fun insight instead of me charging you a product. If you appreciate the information I offer, which by the way, you can always come back here every week for free. I'm going to leave my PayPal link in the description below. You can donate $1, 50 bucks, whatever you want, and I will give you that WhatsApp link to talk with me directly. And if you want to support the channel in other ways and get some more really good information to track your portfolio, we do offer spreadsheets at thechartmaster.com. You buy one, you get them all for free. But I want to iterate, guys, taking financial advice from people right now is extremely challenging. I've heard Elon Musk tweet out that you really only need to own several different stocks and companies you believe in, and so long as their products don't change over a long period of time, never sell them. And I just think it's terrible advice. I think anybody offering individual stock advice where you're kind of not really understanding what the long-term investment thesis is, which the thesis basically stands that over a 30-year period, less than 1% of people will outperform the basic indexes, that most people, 99% of people, should just be cost averaging into index funds and maybe hand select a few companies and make them the smaller weighting of your portfolio. Because really, if you picked 7 stocks, guys, and a lot of them were in small caps or speculations, and 3 or 4 of those just did horrendously, it would ruin your entire investment timeline. And that's something that I really don't want to see from anybody. And I really want to pass that question off to you at this point, guys. What are you doing with your portfolio? Many of you in our chat groups are just wading into index funds, and I've learned so much from people trying to figure out my own risk tolerance because I am not perfect at this by any metric. Luckily, me kind of finicking around over the last several years with individual stocks in my portfolio has led to outsized returns. And again, I do not have the cojones that I used to have with the sizable accounts that I have today because I just do not want to wipe out all of those years of hard work. So in this time, guys, I'm going to take a breath back, cost average into those index funds, and we'll just see what the markets do. And inevitably, I am looking back to getting into growth when it starts making the best sense. And we're going to talk about that in some later videos. But let me know what you think in that comment section below. Stay cool, stay awesome. And as always, I look forward to catching you in the next one.